My name is Stellah Swakei, a fixed income research associate at Standard Investment Bank. We'll be covering the performance of the fixed income market in the current market environment. So the fixed income market started the year on a rather positive note, seeing that the Treasury bill subscription was slightly oversubscribed, with the overall subscription coming in at 104.8%. And the government also issued 2 bonds for the month of January, which again were undersubscribed, and this was mainly on the back of the tightened liquidity in the money market, as well as the investors' continued preference for liquidity. As we had predicted at the beginning of the year, liquidity in the interbank market remained tightened in the month of January, with the interbank rate averaging between 5.2% and 6.6%, and this was mainly on the back of increased outflows to the central bank in payment of T-bills, T-bonds, as well as reverse repos. As has been the norm again, the central bank maintained its support to the liquidity-strapped entities by providing reverse repos in the open market operations. The Monetary Policy Committee met last week and decided to maintain the central bank rate at 8.75%, and this was on the back of the easing inflationary pressures, and it was despite the progressive rate hikes in the advanced economies such as the USA and UK, which increased their central bank rates by 25 bips and 50 bips respectively. In addition, the Stanbic PMI report was released last week, and it pointed towards an improving business environment in the private sector, and this was on the back of the increasing demand and an increase in new business growth. We expect the business environment to continue improving as inflationary pressures ease, but risks lie on the downside on the back of the elevated prices of input materials. The fixed income market is currently offering yields that were last seen in 2016, mainly because of the heightened perceived risk as well as the tightened liquidity in the money market. The 182-day paper and the 364-day paper already surpassed the 10% psychological mark that the government was so keen on not to surpass. Similarly, the Treasury bonds are offering high returns of above 14% depending on the tenor of the bond. Going forward, we expect to see eased inflationary pressures, which will consequently lead to a decline in the rates in the government papers. As such, we recommend investors to secure their yields in the current interest rate environment as the global economy as well as the domestic economy continues to stabilize.